Hello, you're welcome once again to Young Investor Network series on financial literacy. Wow, it's been a while. The last time we met, we discussed present value, future value calculations, and then I got a lot of positive feedbacks. Yes. I really enjoyed. And we promised you that the next time we will come back is going to be bond valuation, and that is exactly what we're coming to do today. So yeah, this has been Young Investor Network series on financial literacy, where we seek to educate the public, where we seek to educate each and everyone, no matter who you are, on finance, with the help of technology like Excel, in all our dealings and in all our calculations. So sit back, relax, and enjoy. Today is about bond valuation. We will discuss what bonds are, and then we'll do some calculations on bond pricing. Look at some features as well. So let's not waste much time. Let's just get back to business. All right. So basically, when you say a bond is just a long-term debt instrument issued by corporate bodies and governments to raise funds from investors. All right, where they promise, that is, the bond issuer can be a company or the government promises to or promise to make a series of payments to the investor or the bondholder for a particular period of time, and then at the last day or at the last period, that is the agreed date, the bondholder is going to receive his or her invested or the amount they gave to the government or the corporate body, that is the bond issuer. Then bonds also have some features like the face value, that is the price at which the bond is being sold in the market, that is the amount you have to pay for the bond. Then we have the coupon rate, that is the interest that the bond issuer is giving to the investor. Then we have the yield to maturity. The yield to maturity is also known as the interest rate, that is the rate at which the market is willing to offer, that is the interest rate on the market. Then we have the period. The period is just the duration or the maturity of the bond. Now in bond computations, there are some factors that you should consider. The payment can be annual, semi-annual, quarterly, or depending on the agreement between the bondholder and then the issuer, how the payment is going to be. In our case, since we are in Ghana here, we have our bond payments or our coupon payments in 6 months, semi-annual. So when this happens, it means that anytime you are computing the price of a bond, you will need to first of all look at the rate, that is the coupon rate, look at the yield to maturity, and then the period. So as we have seen here, I have already computed the price of a bond. In here we will clear it and then we'll go through together. In this case, it's a 3-year bond that has been issued by a company, hypothetical one of course. 1 million face value, the coupon rate is 15.15%. Then we have the yield to maturity is 24.51%. Then the duration or the period is 3 years. All right, since it is a semi-annual coupon payments, we will need to first of all convert these rates, that is the coupon rate, the yield to maturity, and then the period to semi-annual. So first of all, let me clear all that I have computed, and then we will do our own calculations. All right, so good. These colors that you see here, these are just telling us that the figures are imputed figures. The color that you see here, they are calculated figures. So the moment you change the imputed figures here, because they've been referenced to the imputed figures, everything will just go off. As you saw, at the moment I cleared the imputed or the calculated figures, every calculation here, almost every one of them left. So let's begin. First of all, like I said, you need to convert the rates to the agreed period, that is the coupon rates or the coupon payment period. In this case, we said it's going to be semi-annual, so we have to convert the rate here to semi-annual by dividing the rate, that's the coupon rate, by 2, and then we have to convert the yield to maturity by 2, so the yield to maturity by 2, and then we'll go to the period before we come to the coupon. So the period here must also be converted semi-annual, a 3-year times 2, so 6 equal payment, or 6 periods or periodic payments. Now, before you can calculate the price of a bond, you will need a coupon, and the coupon here is what the bond issuer is giving to the bond holder over a particular period of time, and it's going to be the same. It's fixed. It normally doesn't change, all right, over time. So with this 6-year or 3-year bond, which is going to be paid 6 times over the 3-year period, the coupon to be received is going to be the coupon rate times the face value. All right, so there we have it. Let me clear what I have here. Okay, it's just giving us evidence of what I told you about the reference. Okay, so it tells us that every 6 months or on semi-annual basis, the coupon to be received by the bond holder or to be paid by the bond issuer is 75,750 Ghana cedis. All right, over the 6-year period. So let's prepare our price of the bond over the 6-year period with these computations here. I have already prepared the table. So like we said, every 6 months the bondholder is going to receive 75,750. So it means that we just have to reference it over the 6-year period. So all that we have to do is to lock this year 1, that is the B8, by using the F4 key, shift F4, or the $sign. All right, then you just drag it. Okay, so there we have it. So every 6 months, so this is the first, second, third, fourth, fifth, and then the 6th period. For 3 years, the bondholder is going to receive 75, 75, 75, 75, 75, 75. But at the last period, the bondholder is going to receive this 775,750 in addition to the amount it gave to the bond issuer. So we just have to reference that one as well. All right, we don't want to add it up straightforward because some may not understand, they may be confused, especially those who don't get the theoretical explanations well. So I have brought it down here. All right, so we go back to what we did. Those who were able to watch the video and then understood it, you will know how to do the calculations of a present value investment. So to be able to convert these figures into present value, the reason why you are converting them into today's terms or the present value is because you are going to receive the 75,750 next year, 6 months time. 6 months time, let me put it that way. So you would want to know its value today to know whether the coupon rate that is being offered is really, something that you are okay with. So how then do you do that? So the last time we said to be able to convert the present value into today's terms, or you have to, the future value into today's terms, all you have to do is to discount the cash flows, the future value, by 1 plus the rates. And in this case, our rate is going to be the yield to maturity. That is a market rate. All right, so we close it, then raise it to the power by the period, that is 1. Okay, so we have 60,833.49 Ghana cedis. So this 75,750 coupon that the bond holder is going to receive in 6 months time In today's terms, its value is 60,838.49. All right, so we just have to drag it throughout to get the value over the 6-year period. All right, so let's lock the B4 up. That is the cell B4, that is the yield to maturity, because it is going to remain constant over time. That is, we are holding it constant in this case. It is not always that it's constant. All right, so we lock it up and then we reference it to the 6th period. All right, so we can see that the price or the value keeps reducing. So it's like the longer the period or the duration, the lower the value into today's terms. And that is very, very true. You are going to receive this money in 3 years time. That is this 75,750, the last semi-annual payment to be received. Into today's terms, it is 20,330.93. all right, so that is what we have done for the 6 payments. Now, what about the amount you gave to the investor? You would still want to know its value into today's terms. Yeah, so let's do that one too as well. So we reference it, then we divide it by, same as we did for the coupon payments, by the yield to maturity, and then raised to the power the period. In this case, you are giving the money to the bond issuer for 6 years, so you'd want to discount it into today's terms, so 6 years. All right, so there we have it. Yeah, oh, sorry, we are using the yield to maturity over here instead. Let's see. Oh my goodness, we just have to change, because we are using the semi-annual, we have to use the converted, the already converted, and not the first one. So we just have to use the converted value here, look it up. All right, so that is how it's going to be. It doesn't change much. That is it. So there we have it. Now you would want to know the price of the bond in total, and to find the price of the bond, that is the face value in addition to the coupon that you are going to receive over the period, you just sum them up. So sum, using the sum function in Excel, all of this. All right, so there we have it. So this 1 million Ghana cedi bond that you have given to the bond issuer, and this coupon that you are going to receive, the two payments or the two cash flows into today's terms is 808,967.78. all right, so basically that is how you calculate the price of a bond. Now let's look at some interesting features of a bond. This is a data let's see. All right, data table. I did a data table of the yield to maturity and then the coupon rate. So as we can see here, the yield to maturity is over here and they keep increasing over time. Then we have the coupon payments keep also increasing over time. All right, this is only to explain some interesting features or some interesting aspect of bonds. That is basically the relationship between the price of a bond and the yield to maturity. All right, so let's look at the interesting part. From our analysis, or in our analysis, we use the coupon rate of 7.58%. That is what we see here, and then the yield to maturity of 12.26%. that is over here. So in our calculations, we got the price of the bond to be 808,967.78. all right, and that is exactly what we see here. Now, because the coupon rate doesn't change over time and the yield to maturity, we held it constant here, which may change. Let's look at how the analysis is going to be. Assuming the coupon rate is constant, it doesn't change, and the yield to maturity is to increase to 13%. What then becomes of the price of the bond? It falls further to 7,831 32.94. If it is to increase again to 14%, you can tell that it falls to 750,153.11. It goes on and on, on and on, and on, and on, like that. All right, that tells you the inverse relationship. Let's look at this from this angle. Assuming the coupon rate is 15% and the price of the bond is 16%, let's look at the amount that you are going to get. It is 96315.2.64. all right, what if the coupon is 15% and then the yield to maturity reduces to 14%? What then becomes of the price? What then becomes the price of the bond, which is 1,038,886.68? Wow, are we getting the relationship here? I hope we do. All right, now this explains three main things. All right, we'll do the other one. When the coupon rate was lower than the yield to maturity, you realize that the price of the bond was very low. It tells you that the bond is being priced at a discount. All right, so the coupon rate is lower than the yield to maturity. Now when the coupon rate becomes higher than the yield to maturity, it tells you that the bond is being priced at a premium. That's the basic explanation. Now let's look at an interesting part here, that is yield to maturity being 15% and a coupon rate being 15%. What then is the price of the bond? It is the same. That is 1 million Ghana cedis. It tells you that the bond is being priced at par. Let's look at 14%. We are getting 1 million. The bond is being priced at par, or it has been priced at par. So viewers, this has been a short analysis on bond valuations from Young Investor Network Financial Literacy series, and then today we have taken you through how to compute the price of a bond. All right, I hope you enjoyed it. As time goes on, more analysis will be done. If you have any question, if you have any comment, please go ahead, ask, and then we will get back to you. All right, you can like, or you should like I must say, share, and then subscribe as well, so that everybody will get to know what we are doing and the relevance of it all, so that in the end we will all enjoy. Remember, we all don't know anything, we are all learning, so you can critique alongside. Where we have faulted, yes, correct us. Where you think there's the need for us to improve, please go ahead and do so. All right.